Hello and welcome to this video on demand-side responses to the global financial crisis. In this video, we're going to look at a second interesting period of economic history, a much more recent one, and that is the global financial crisis that happened late 2007 and the effects of which can still be felt today. Again, we're going to focus on the government's responses to the crisis in the UK and the USA in terms of fiscal and monetary policy. So let's start off with a very brief explanation of what caused the global financial crisis. And really this was sparked in the USA, but also was kind of occurring throughout many Western economies. And really we can start it by looking at the housing market. So low mortgage rates meant that it was relatively cheap for people to buy homes, and there was a great increase in the lending of mortgages for people to buy houses. Now, some of these loans that had been made to people who were going to really struggle to pay back these loans in future. And these people were called subprime customers. And eventually there was a problem when the people who'd been lent these mortgages, as house prices kind of started to not increase as much, struggled to pay back their loans. And as a result, the banks who'd made those loans had a shortfall in cash and started to run out of money. Perhaps most famous of which was Lehman Brothers, which was a bank that went bust. And this was symptomatic of what was happening in a lot of banks at the time. So there were a number of banking failures, banks running out of money, not being able to provide cash to people who deposited it with them. And that's quite significant. If you think about an economy without a safe and secure banking system, it's very difficult for an economy to operate. Where do people keep their money? Where do businesses go to get short-term loans? And so this had a very significant impact on the performance of the global economy. Stock markets fell. People felt a lot less certain and confident. People felt a lot less wealthy. And as a result, there was quite a significant impact on economies as GDP fell and unemployment started to rise. Now, this impact which was started in the US housing market spread throughout the world. Banks are very interconnected and also had made these types of loans. So here's a few examples. A famous example in the UK was Northern Rock. This was a bank that had great difficulty finding finance to keep itself going. And famously, there were lots of queues of people outside Northern Rock trying to withdraw their savings, uncertain that they would get it back. A number of other banks were affected. Lloyds, Royal Bank of Scotland, HSBC and Barclays all had to admit that they were having problems staying afloat, and they had to be bailed out by the governments, had to give them money to kind of tie them over and keep them going. So that's the crisis that we had, and the impact of it was quite significant. So for example, here we have a look at the USA's GDP growth. We can see as it enters recession in 2008, and it didn't really recover until 2010 or late 2009 when it left recession. So we've got kind of an 18 months recession going on here in the USA, which had a significant impact on things like unemployment. So unemployment rose from about 10% to just under 18% over that time period. In the UK, a similar story. We can see a recession here, negative economic growth occurring throughout 2008, 2009, and then eventually in early 2010, or late 2009, the economy comes out of recession. In terms of the impact on the economy, we can see similarly an increase in unemployment from just under 6% to above 8% over that time period. Inflation, there was initially a period of falling inflation, but actually inflation remained relatively high throughout this recession, unlike the Great Depression. So what was the fiscal policy response? Well, first of all, in the USA, President Obama introduced a large fiscal stimulus. And the key here was that it was straight away as compared with the American response in the Great Depression. So they introduced a fiscal stimulus plan, a kind of boost in government spending worth almost 66% of that year's GDP. And it was quite, although some of it was a long-term program, more than 90% of the impact came into effect before the end of 2011. The stimulus itself was a mix between tax cuts for businesses, but also some spending on health, education, social security, and infrastructure. In terms of monetary policy, the Federal Reserve, the central bank of the USA, well, straight away they cut interest rates from 5.25% down to 0.25% in 2008. So a very significant cut to interest rates to try and boost the economy. They also announced a significant program of quantitative easing. And by the end of October 2014, they'd spent $4.5 trillion on a quantitative easing program. The chairman of the Federal Reserve, the head of the Central Bank of America at the time, suggested that QE had raised economic activity by almost 2% and increased 3% and increased private sector jobs by 2 million. So it helped with the economic recovery. In the UK, what was the fiscal policy response? Well, in the early days, straight away, pretty much, Gordon Brown introduced a number of fiscal measures which amounted to 2.2% of GDP. So there was a reduction in VAT, support for the construction sector, spending on infrastructure for schools, spending on hospitals and green energy, training for the unemployed. However, by 2010, the UK did have a new government. The coalition, Conservative and Lib Dem government had taken over, and they were more concerned actually with balancing the budget deficit. So they kind of reduced the fiscal stimulus program that had been put in place when they came to power, in contrast to the US, where balancing the budget was considered less of a priority under Obama's administration. In terms of the UK monetary policy response, well, similar to the Federal Reserve in the USA, the Bank of England cut the base rate of interest sharply from 5.75% in 2007 to eventually 0.5% by March 2009. They also introduced a large program of quantitative easing. They spent £375 billion on it by 2014. And their figures suggested that the first round of quantitative easing, the first £200 billion that they spent, helped increase UK annual economic output by between 1.5% to 2%. Although there's some critics that argued that the institutions that received the extra cash from QE just hoarded it and didn't really increase their lending to businesses and households. So in terms of evaluating the response to the global financial crisis, one of the key features is that the responses were much quicker than the Great Depression and much more expansionary. And a lot of lessons had been learnt from the economics of John Maynard Keynes, who had suggested the active role for government in trying to manage the economy, whereas in the 1930s, the initial classical approach hadn't really worked so well. Comparing between countries is quite tricky. Both the UK and US economies did improve, although you could argue that, in contrast to the Great Depression, the UK experience was a bit harsher than the US this time round. So the recovery growth rates were similar up to 2011, but then diverged. The US continued to have modest growth, but the UK's growth rate did plateau and stall between 2011 and about 2013. That's it. Thanks very much.